Y'all ready for this? Let's go.
Welcome back to the Ben James Smith podcast. Over the past few episodes, we've talked about structural supply shortages, the rental market, and why institutional capital is moving into UK residential property. Today, I want to bring those ideas together because there is one factor that sits at the centre of all of them: capital. Not just how much capital you have, but how it is controlled. Because in property investment, the difference between success and failure is often not the asset. It's the capital structure behind it. Part 1. The traditional model. Most property development follows a familiar pattern. A developer identifies an opportunity. They secure debt from a lender. They raise equity from investors. They deliver the project. Then they exit and repeat. On the surface, this works, but structurally it introduces something very important. Dependency. Dependency on lenders. Dependency on investor timing. Dependency on refinancing. And each of those dependencies introduces risk, not always visible in good markets, but very visible in uncertain ones. Part 2, where risk really sits. Most people assume risk sits in the property, location, planning, construction, but sophisticated investors know something different. Risk often sits in timing. Can you refinance when you need to? Can you extend when markets slow? Can you hold when conditions change? If the answer is no, the asset doesn't matter because the outcome becomes forced, and forced outcomes are where value is lost. Part 3, the constraint of external capital. When a platform relies on third-party funding for each transaction, it loses control over timing. You may see a good opportunity today, but capital may not be available today, or it may be available on terms that change the risk profile. So decision-making becomes reactive. Instead of asking, is this a good investment? You start asking, can we fund this? And that is a completely different mindset, one that reduces selectivity. Part 4, what happens when capital is controlled? Now let's look at the alternative. When capital is controlled at the platform level via a fund, rather than raised per deal, something fundamental changes. The fund platform no longer negotiates for capital, it allocates capital. That shift does 3 important things. First, it removes timing pressure. You can act when opportunities arise, not when funding aligns. Second, it increases discipline, because you are not trying to deploy capital to satisfy investors. You are selecting opportunities that meet your criteria. Third, it improves consistency, because the same capital is deployed through the same framework every time. Part 5 on why this matters for scale. This is where scalability comes in. When capital is fragmented and raised per deal, growth creates friction. More deals require more fundraising. More fundraising requires more explanation. More explanation increases uncertainty. But when capital is centralized, growth becomes operational rather than financial. The fund platform doesn't need to re-justify itself each time. It simply executes. And that allows scale without increasing complexity at the same rate. Part 6, the institutional perspective. This is why institutional investors care deeply about capital structure. They don't just ask, what are you investing in? They ask, how is the capital controlled? Because control determines behavior, and behavior determines outcomes. A well-structured fund platform removes unnecessary pressure. It allows patience. It allows selectivity. It allows decisions to be made based on merit, not necessity. So when thinking about property investment, it's worth reframing the question. Instead of asking, is this a good deal? Ask, is this a good system for deploying capital? Because deals come and go, but systems determine long-term performance. Thanks for listening. And remember, in property investment, the asset creates the opportunity, but the capital structure determines the outcome. I'll see you in the next episode.